Hey, Bowtie Nation, Joseph Hogue here at the FinCon Investor Conference with Ari Gutman. Wanted to talk to Ari because it's something we don't usually talk about, is this whole concept of your investor profile and really how to make sure you're investing in the stocks and the investments that suit yourself. Okay, I think we have commoditized investing in that it's a one-size-fits-all, and the best stocks for me are the best stocks for you. Well, that is not the case, and you really do need to know yourself as an investor and really fine-tune your investing strategy. So, Ari, thank you for being here with us. Why don't you take us through kind of a real quick when you got started investing and how you started developing this concept of an investor profile.
Yeah, absolutely. So first and foremost, thank you so much for having me on. Huge fan, been a huge fan for a while. Who isn't a huge fan of Bowtie Nation? Should have came with a bow tie. But Joseph, the reality for me is I got started as a younger investor in my early 20s. And the first thing I did is I just threw a lump sum of money into an index fund, which isn't bad. But from there, I actually got heavily invested into dividend stocks. Also not terribly bad. But all things considered, this thing we keep going back to, this investor profile, it really wasn't, as I look at it now, suitable for me as an early 20-somethings investor. And everybody would tell me sometimes in the comments, you should go more growth. But at this point in time, it was dividend yield, retire early. And so I was really hyped up about these dividends. And it did get me going, but the thing was, based on the timeline that I had, which was decades in the market, I lost out on a lot of growth, and I see it happening time and time again. We're both creators, we're both making a lot of content about stocks to buy now, best ETFs. And when we make that content, I think we get a lot of people revved up to get involved in certain stocks. And sometimes, as you just shared, it's not the right stock. So I keep going back to this thing called the investor profile, which is really understanding yourself as an investor to invest accordingly.
Okay, great. And it's a great point, and something that I want to beat home and keep beating home is that index funds might be great. Dividend funds, we love dividend funds here on the channel, or dividend stocks and dividend ETFs, but not for every investor. Okay, you really do need to know how certain types of investments behave, the risk profile within those, and what you need as an investor. Okay, someone like myself, maybe a little bit older, might need that income and that stability from index funds, from dividends. Ari, a little bit younger, and especially when you were starting out, when I was starting out, you don't necessarily need that stability. You need the growth to grow your portfolio quickly. So eventually, when you do switch to dividends, you're collecting a lot more income. So it's very important to know how certain investments behave, their level of risk, their level of return, and to be able to match that with your investor profile. But what is an investor profile?
It's a great question. I get asked that a lot. I started talking about the investor profile a lot on my channel, really harping on it. But to me, the investor profile, again, goes back to who you are as an investor. So all things considered, you got to take a look at your age. You got to take a look at your investment timeline. Your risk tolerance is huge, right? Because even though I was a 20-somethings investor at the time when I started investing, my risk tolerance really wasn't there. So I needed that suitability and comfortability to invest. But again, as I gained more experience, I think a big mistake that I made was I stayed in the dividend investing lane. And to top that off, I think a big picture, we need to take a look at how much time we actually have to spend in the market. If you have decades worth of time, well, you could be a little bit more comfortable taking on some more risk. Now, in the very beginning, even if you take on risk and you lose, you're not always going to win. I wish that was the case. It certainly wasn't for me. But you're not always going to win. So going back to that, even a couple of L's, I like to say, losing here and there, just taking on some risk, is really just a tuition bill. And you get the hang of it, but then you also find stocks and investments that you feel comfortable with, even if it's just something as simple as you want to quote unquote call it Google a riskier stock, but we all use Google. And so I was going in that dividend investment lane, and I'll just give you a quick example. When I switched from a dividend investor, like a hardcore dividend investor, to a more growth-oriented or hybrid investor, that year was transformative for my portfolio. Over $100,000 that year, just going almost all in on growth. So I look back and I'm like, wow, 10 to 12 years, I could have been throwing more and more money into a growth-oriented, if I wanted to play it really safe, growth-oriented tech ETF, and I could have made a lot more than I made just with dividends.
Excellent.
And as you shared, right, when I get older, I'll switch back to
Sure.
more dividend orientation.
And I think it's so important. And it all comes back to, a lot of that investor profile comes back to that idea of risk. It's something that we just don't talk about very much here at any channel on YouTube. And it's so important for your investor profile and how you invest. And that risk tolerance, is really broken down into two segments: your willingness to take risk, how much those ups and downs of the market cause you emotional pain and stress, as well as your ability to tolerate risk, okay? Your ability to tolerate risk are things like, is your income very secured? Do you have a high or low level of income risk, right? So if you're in a union or a protected job, you don't have very much income risk, so you can take more financial risk. You can invest in the riskier stocks because you're probably not going to lose your income. On the other hand, if you're an entrepreneur or in a very cyclical job, your income risk is going to be higher, so maybe you want to take a little bit less risk. Your ability to take risk in your stocks might be lower. Another part of that is how much money you have saved up versus how much you're going to need in your eventuality. And perversely here, then if you have a lot of money already saved up, you can actually take more risk because you can take the L. Like you said, you can make a few more learning losses, and you'll still be okay. If you haven't been saving up very much, you actually need a little less risk because, and especially as you get older, if you have less money saved up, you're going to want to take less risk and not try to catch up real quick, because those catch-up investments often become those catch-up mistakes, and you have even less money. Then over on your willingness, this is much more of the emotional side of risk. If you run to your favorite YouTube channel every time your stock falls 3%, begging for an update on that stock, and it causes you to lose sleep, you should not be investing in that stock. I'm sorry, I know everyone wants to get rich and solve their portfolio overnight with these high growth, high return stocks. But if it is causing you emotional stress, folks, just find something less risky, okay? So that is your willingness to invest, willingness to tolerate risk. You take those, you put those together and decide, okay, do I want the index funds? Do I want the dividend stocks that are a little less risky, maybe less return, but a lot less risky and a lot more palatable to your sanity? Or can I take that risk, and can I take the growth stocks and that kind of thing? So great point. Tell us a little bit about your investing journey and how this has all worked together. What was your biggest investing mistake?
The biggest investing mistake, I think I just jumped in. I jumped right into the market. I got very excited, as everybody does. I always like to say these days, you don't have to get rich by Tuesday. Maybe Wednesday, but not Tuesday.
Friday's good, because then you got it for
Friday.
the weekend. Sure.
You got the weekend to take it all in.
There you go.
But over time, this is really a marathon and not a sprint. And I think when you get that initial investment bug, you jump in, you want to capture everything. So even just a couple of mistakes that I made early on, I loaded up on a lot of positions in my portfolio. And I always go back to this video I was watching. It was an interview with Bill Ackman.
Okay.
I'm a big Bill Ackman guy. And Bill Ackman was sharing with the audience that at any given time, there's really only 5 high quality holdings out there to put in your portfolio. And I looked at my portfolio and I had 40, 50, and I'm like, wow, what happens if I double down on the highest conviction stocks? So that was a big mover for me in my portfolio. The other one, again, going back to that investor profile, I always harp on this. Because I didn't understand where I was, who I was as an investor, there was no way for me to get my portfolio just right for me. And now that I have a hang on that, my risk tolerance level, my timeline, I feel so much more comfortable and confident as an investor, knowing I'm more in growth these days. I still have some dividend stocks, still love the dividends coming in, but they're much lower yield. And I'm talking yield under 1.5%. So really they're growth-oriented stocks because, Joseph, I got decades worth of time to go in the market. I don't want to play it so safe, overbearingly safe, that I miss out on that growth, which, by the way, I got to shout you out. It's been a lot of watching your channel along the way as well for stock ideas, growth stock ideas, even dividend income ETFs when I first started out. And so to go back to this, you find your YouTubers, just make sure when you find those YouTubers or creators, you go back to your own investor profile. We still have these great ideas. You can capture a lot of them on Joseph's channel. You just need to make sure they're suitable for you.
Sure, definitely. And something else that you touched on there, you had 40 stocks. I know a lot of investors, 40, 50, 60 stocks, even more. And you get all these great ideas. But you got to understand, when we talk about stocks here on YouTube, a lot of the other financials channels here on YouTube, they're pitching those stocks, but it might not be right for you, okay? The 5 best stocks to buy right now actually aren't the best stocks to buy for your situation, for your investor profile, okay? A lot of these are maybe news-driven, news-related, and so you really do need to take the time to think through these stocks, whether they're right for your investor profile, whether they're right just for your way of thinking about stocks. And then, like you said, you had 40 stocks, culling them down quickly, okay? We all have that tendency to hold on to our losers, just trying to get back to even. We end up going to church more often because we're just trying to get back to even on those losing stocks. Cut them quick, ride your winners up, okay? People take profits way too quick on their winning stocks. You know, how many times have you kicked yourself for selling Nvidia before that big jump in the price, or Tesla before it was rising? So hold on to your winners, sell your losers quickly, and make sure those stocks are right for you. A lot of this, I think, comes back down to kind of those emotional decision making. So how do you avoid that? How do you avoid making those emotional decisions like FOMO, like panic selling?
I try, this is hard, but I try to totally pull myself out of all the noise of the market. I even over the years have stopped watching as many YouTube videos. I try to keep myself to like 2 to 3 creators that I really resonate with. And then on top of that, I try to watch the news a little bit less. I feel like there's a lot of fear mongering that's out there. And if you're not well versed in the news and the markets and you see these headlines, they're pretty terrifying. And so you see something like, Jerome Powell may or may not cut rates, the market gyrates, and all of a sudden you feel your stomach a little, with some butterflies in there. And so I try not to have my ears too much in the news and the noise. And I focus, again, I go back to this focus of the long term. If something is happening, today, tomorrow, next week, well, in 10 to 20 to 30 years, is it going to be relevant? And when I look at that, more granular perspective, it really calms me down. So when I run with the notion, again, get rich by Tuesday, it's like this go, 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 invest, and I find myself making all those mistakes. When I zoom out, I sit quietly. I always like to tell myself, Ari, take a breath, man. Like you're a marathon runner. You're not a sprinter right now.
It's a long-term thing, and something I want to bring that back to, and a concept, because I know we said, the ETFs, the index funds might not be right for you, but I do like one way to use index funds, one way to use ETFs is through that core satellite strategy that we talk about on the channel. So even if you are a high-risk investor, someone that does have decades left to invest, and someone that is able to take a lot of that risk, and you want those growth stocks, you want those higher risk, higher return stocks, you can still lower the overall risk in your portfolio so you don't make those emotional decisions, right? So what you do in that core satellite strategy, instead of, and it just starts with 60 or 70% or 50% most of your money in some kind of ETFs, okay? For the lower risk investors, that would be index funds, that would be broader ETFs like the S&P 500, the SPY. For a higher risk investor, then you would have the ETFs focused on those growth stocks still, okay? So you would have maybe the cyber, the CIBR, which is the cybersecurity ETF. You would have some of these other, maybe the IGM, which is a tech and all tech ETF. So those ETFs themselves, they would have a little bit higher risk, a little bit higher return than your broader SPY, your broader index funds. But what you still get with those ETFs is a broad, 50, 60, 100 stocks in that ETF, so you get a little less risk. When you have that 50, 60% of your portfolio in those ETFs, and then your growth stocks, your individual stocks with the rest, the 30 or 40%, then you still have that chance to beat the market, to get rich by Tuesday or Friday, right? So you still do have that higher return potential, but you still have a lot of your money in those less risky ETFs. You're gonna see your portfolio bounce around a lot less, and you're gonna get a lot fewer of those butterflies in your stomach. So a great way to kind of balance this idea of risk. You want that higher risk investments, but you still do kind of get worried about your portfolio a little bit. So great way to invest there, great way to avoid some of those emotional decisions that come with just a crazy roller coaster stock market that we see all the time. So what would, bring this all together, what would you tell your younger self to avoid some of this mess?
It's like the golden ticket question, I feel like. If we can all go back in time, what would we tell ourselves? I think about this often because a lot of, at least in my channel, I try to go with that question, like what would I tell myself as a younger investor? How can I best help myself? And I found that when I'm sharing from that point of view, it helps a lot more people than just me thinking about me in the future. So if I had, could tell my younger self one thing, it would be to kind of have this open palm mentality of just like learning, taking everything in, and never close your mind off to certain strategies, certain investments. And I started this all came from starting a podcast, to be honest with you, because I was that dividend investor, dividend-centric investor. And I started interviewing a lot of different investors, some hedge fund managers, CEOs, CIOs, and then most importantly, a lot of all of you, a lot of retail investors. And everybody had these different strategies. And I was like, why am I so stuck on one strategy and one focus? And I was able then from that point moving forward to really open up my mind to different strategies, really put together my investor profile and starting to invest as I should be, at least as I feel like as a 31-year-old investor where I have that decades to go. And so now here I am today. The one thing I just try to do every single day, whether it's meeting authors here at FinCon, meeting men like yourself, people I look up to, talk, ask questions. Don't fixate on one strategy. Don't have your portfolio, kind of just stuck as it is for decades. Be versatile, be open, learn.
Excellent. And let's so how about a roadmap for all of this? Okay, so take a moment. It's a lot less than the research that you have to do for individual stocks, okay, but it is so much more powerful for your overall investing strategy and your overall wealth. Okay, so take a moment, think about your investor profile, especially that risk tolerance. What's your ability to take risk? Do you have a stable, secure income? Can you take a little bit more financial risk? Do you already have a very good sized portfolio and you can take a little bit more risk because you can take the L every once in a while and still be okay with your goals? Your tolerance or your willingness to take risk. Yeah, a lot of us, we've sat through some of these corrections, even some of the recessions, even some of the crashes, and we know how we reacted to it. So think back on that, then take that back to your portfolio. How many stocks do you have? How many ETFs do you have? What are your ETFs? Think about this. It takes less than probably an hour, maybe 2 hours, to really think about this, fine-tune your portfolio. Don't make the decision all at once, though. Do not go through this exercise. Decide that you need to cut half of your portfolio and then do it immediately, rushing off to your broker. Okay, give it a couple of days, revisit it, think about it again, and just really make those long-term decisions instead of the knee-jerk reactions and selling out a lot of your great stocks. Ari, I want to thank you. How's the best way for people to find you here on YouTube?
You can find me here on YouTube, just my name, Ari Gutman, podcast as well. I'm a co-host, so Ryan Williams is my other co-host there. You can find us on the Deep End or just my channel, Ari Gutman.
Ari Gutman. Okay, so I will put a link to the channels there in the description. Check those out and some great information. I appreciate it. Thank you.
Thank you so much.